Hello and welcome. You're watching NDTV Profit and I'm Harsh Saita. You're watching Earnings Edge, and Cholamandalam Finance is the first management we're focusing on. Before we speak to the management about the first quarter performance, an important update from the earnings con call that has come through. The lender has cut FY26 disbursement guidance to 10% from the earlier 15 to 20%. It's also seeing an uptick in credit costs, and that has been a concern with regard to Q1. We spoke with Mr. Arul Selvan, who is the President and CFO of Chola Investment and Finance, on all of these. My first question to you, sir, is about the spike in loan losses. What has caused them, and what are your concerns where FY26 is concerned? Give us that perspective.
Loan losses in vehicle finance had been little high because typically in Q1 this happens to be little high, but this time it had been, I would say normally it had been slightly higher than the normal pace in which it would have shifted in Q1. This is primarily because of the early onset of monsoon that has made the vehicle utilization levels drop, and that is where the earning potential of the current borrowers have been hampered. We expect that the monsoon should get over by September, in which case again because of the early festival season starting in September itself, there should be traction with these borrowers, which could help them bounce back quickly in Q2 itself, or at least the fag end of Q2 and in Q3 certainly. The monsoon would be the critical factor for their bouncing back. That's on the vehicle finance. LAP and HL had been, from a loan loss perspective, had been fairly okay. Normally, there will always be a small spike in Q1, which is what they've gone through. The other segment is the CSEL, where as we have already iterated, the exit of the fintech partnership still has some pains, and that is what we are going through on the CSEL side of it. The fintech losses, because there's no incremental disbursements coming in, it seems to be little aggravated. That should run down over the next 3 quarters, and after that this pain will not be there for us to expose on this side of it. SME has been fairly okay. What we have done is we have consciously exited certain low ROTA products because it is not adding ROTA to the overall company level ROTA expectations, and they've been fairly low, which is like supply chain finance and loan against shares. That is what is showing up on the disbursement being negative in SME segment. Actually, if you see, AUM has still grown because both the supply chain and loan against share segments are very short tenor, and they result in more churn and more OPEX, and thereby there is very little profitability at the end of the day. So we have consciously exited this product, or at least I would say slow down on this product.
Got it. So on the SME side, are you penciling in more pain? Is that what is visible? Or because majorly what I gather from what you're saying, majorly everything is seasonal and should taper down starting Q2. Is that the correct sense I'm getting?
Absolutely, because if you look at it, actually we tried to present it, if you see, we slightly shifted the investor presentation to bring in the SME ecosystem itself and where we are playing in this ecosystem. So if you look at it, LAP continues to do well, which is also a large part of the SME. And I wouldn't say it is a pain on account of the credit, it is more a conscious decision to exit certain products where it is not meeting up to the expected ROTA levels. That is the only issue rather than credit issue in this segment.
Do you see, sir, a pickup with regard to growth across the board, because, and excluding SME maybe, because that's the commentary you're giving, but excluding SME, are you seeing growth especially in HCV? Give us that perspective. And then in other in other vehicle finance as well, are you starting to see meaningful growth likely in Q2, Q3?
In Q2, it will still be muted. As you know, Q2 is also impacted by monsoons, a large part of that Q2. and the inauspicious months across the country, keeps the activity levels low. So in vehicle finance, you will see little muted growth as well as traction even from a credit angle in Q2. But it should improve at the fag end of Q2 when the monsoon is expected to end. The only prayers would be to make sure, to ensure that the monsoons don't get extended like last year, where it went all the way, to the mid of Q3. If such thing happens, yes, it could be a little bit negative more on the vehicle finance. But for the rest of the portfolio, I think the traction should start picking up in Q2 and Q3 onwards.
Okay. So let's get an outlook for you for the full year FY26. Your credit costs currently sit at around 1.8% where Q1 is concerned. That should taper down from what you're saying. And therefore, where should you land up at where full year FY26 is concerned on that number?
On the credit ratio, we should be between 1.5 to 1.6% is what I expect right now. On a very conservative note, it should be better than that. But as I said, the large part of it hinges on the monsoon because we still have a very large vehicle finance portfolio, which will, get impacted if the monsoon gets extended. But if the monsoon gets over and then there is a fair bit of the festival season picking up, we should not have any impact. It should come down, at least in the vehicle finance, it should come down to around 1.5, 1.6, which would be more reflective of the full company as a whole number also for the full year.
And growth, you believe underlying growth tailwind remains, given that there is going to be some seasonality effect in H1, but likely H2 should pick up?
Yeah, H2 should pick up. There are multiple factors we are also banking on. One is the change in the norms, which would trigger certain pre-buying in Q4, especially in the HCV segment. Where sorry, I forgot to answer that in the earlier question. So that would pick up the volumes in Q4, and we see the festival season also bringing in more traction on two-wheelers and the passenger cars, etc.
Would a 25% growth likely sustain? Is that kind of a number doable for FY26?
I keep it at the same level what we mentioned, 22 to 23% right now. So can you hold me at that?
Sure. No, absolutely. I understand. So give us the margin picture. You improved 20 bips or so over the last year. We've started to see rate cuts. What's the margin upside looking like?
See, actually, a large part of the cost of fund benefit is not reflected in Q1. You will see it coming more in Q2 and Q3 when the banks start transmitting them. The T-bill related benefit or the EBLR related benefit would show up certainly in Q2. And the MCLR related benefit, which is almost 50% of our bank borrowings, will come more in Q3, Q4 because banks will delay or will tend to progressively give in smaller lots the MCLR changes. So you will see these benefits coming up. Of the total book on the LAP and HL floating rate books, we may have to pass on these benefits, at least part of it, as and when it starts accruing to us. But we stand to benefit on the vehicle finance book, which is a fixed rate book. So we expect overall for the year around 20 bips improvement on cost of funds.
20 bips, and that should translate straight to the margin number. So your margin should go up to 8.
I would say that, as I said, the LAP part we will have to pass it on. So we should land up anywhere between 15% level, 15 bips level, sorry.
Got it. Understood. So just below 8% maybe on the net interest margin front, right? Okay, got it. And sir, therefore, what does this do to ROTA? You've said, or rather ROA for viewer perspective. PBT ROA is what you had guided for the last time we spoke. 3.5% was the target. Can you do that in FY26 is what I want to understand, because we've come off quite sharply from that number.
I know we are behind that number quite heavily in the Q1, but I think the benefit on the NIM side as well as a little bit on the OPEX and reduction on the NCL should take us, somewhere between 3.3 to 3.4%. Again, I'm being conservative at this stage. I don't want to come in. Let Q2 cross. Let us cross the Q2, and then we will be more confident about these numbers, because monsoon is something which is completely, unpredictable. If that gets completed and you have a fairly assured Kharif coming up, then we should be much more confident.
But sir, you're seeing, sorry sir for interrupting, but you're seeing a decent monsoon as of now, right? Or is that at all a concern for you?
Yes, my job is to also say that more on the negative side, so or keep the expectations low,
No,
so that because I have to tell what could go wrong rather than, because if that is addressed, which is certainly not in our hands, and it is a little, as a wild card. So that is why I have to be careful about it, because you should not ignore this part of the conversation and hold me to it.
Well, this was management of Cholamandalam, speaking about the outlook going ahead. But let's see how markets are doing. Let's figure out how